Welcome back to another episode of Financial Fundamentals, where we bring complex financial concepts right to your screen in an understandable and actionable way. Today, we're diving deep into the world of financial ratios. These ratios are essential tools for anyone looking to gauge a company's financial health and make informed investment decisions. We'll break down the most commonly used financial ratios, such as liquidity ratios, profitability ratios, and solvency ratios. By the end, you'll not only understand what these ratios mean, but also how to apply them in real-world scenarios. Let's start with liquidity ratios, which measure a company's ability to cover its short-term obligations. The current ratio is one of the most commonly used liquidity ratios. It is calculated by dividing a company's current assets by its current liabilities. For example, if a company has current assets of $150,000 and current liabilities of $100,000, the current ratio would be 1.5. A current ratio above 1 indicates that the company can cover its short-term obligations, whereas a ratio below 1 suggests potential liquidity issues. Let's visualize this with some data. Next, we have the quick ratio, also known as the acid test ratio. This ratio measures a company's ability to cover its short-term obligations without relying on the sale of inventory. Imagine a company with current assets of $150,000, inventory worth $50,000, and current liabilities of $100,000. The quick ratio would be 1. Here's a comparison of quick ratios for our sample companies. Let's now move on to profitability ratios, which assess a company's ability to generate profit relative to its revenue, assets, or equity. The net profit margin is calculated by dividing net profit by total revenue. This ratio shows the percentage of revenue that remains as profit after all expenses are deducted. Suppose a company has a net profit of $20,000 and total revenue of $200,000. The net profit margin would be 10%. Here's a chart displaying the net profit margins of our sample companies. Next is the return on assets, ROA, which measures how efficiently a company uses its assets to generate profit. It's calculated by dividing net profit by total assets. If a company has a net profit of $20,000 and total assets of $500,000, the ROA would be 4%. Let's visualize the ROA for our sample companies. Now, we'll discuss solvency ratios, which measure a company's ability to meet its long-term obligations. The debt-to-equity ratio is a key solvency ratio. It is calculated by dividing total liabilities by shareholders' equity. For instance, if a company has total liabilities of $300,000 and shareholders' equity of $400,000, the debt-to-equity ratio would be 0.75. Here's a graph showing the debt-to-equity ratios of our sample companies. Another important solvency ratio is the interest coverage ratio, which measures a company's ability to pay interest on its outstanding debt. Suppose a company has an EBIT of $50,000 and interest expense of $10,000. The interest coverage ratio would be 5. Let's visualize the interest coverage ratios for our sample companies. To solidify your understanding, let's go through a few example questions and answers. Question 1. What does a current ratio less than 1 indicate? Answer. A current ratio less than 1 indicates that the company may have difficulty meeting its short-term obligations, as its current liabilities exceed its current assets. Question 2. How can a high debt-to-equity ratio affect a company? Answer. A high debt-to-equity ratio suggests that a company is heavily reliant on debt to finance its operations. This can increase financial risk, especially in times of economic downturn. Question 3. Why is the quick ratio considered a stricter measure than the current ratio? Answer. The quick ratio is considered stricter because it excludes inventory from current assets. Inventory may not be as quickly converted to cash as other current assets like receivables, making the quick ratio a more conservative measure of liquidity. To wrap up, financial ratios offer valuable insights into a company's financial health. They enable investors and analysts to make informed decisions based on quantitative data. We've covered liquidity, profitability, and solvency ratios today. Each type of ratio provides a different perspective, and it's essential to consider them together for a comprehensive analysis. Thank you for joining us in this deep dive into financial ratios. We hope you found this video informative. Subscribe and hit the bell icon for more finance tutorials. Until next time, stay financially savvy.